Hi everyone. In Chapter 2, we're now going to start looking at financial statements, taxes, and cash flow. So here are some of the key concepts and skills. We're going to describe the difference between what accounting value or book value is and market value. We're going to describe the difference between accounting income and cash flow. We're going to look at taxes and tell you how to compute average and marginal tax rates. And then we're going to show you how to determine a firm's cash flow from its financial statements. So those are our three major objectives. What's important is we understand where this information is coming from. So we have the balance sheet, which is where a company reports its assets, liabilities, and equity for a period of time, or for a specific date. The income statement, where the company reports its revenues and expenses, gains and losses for a period of time. Taxes, which is what we have to usually pay to the federal government, right? And then cash flow, which is where we determine the cash flows from our business, which is different than the profit. So again, the balance sheet. Remember, it's a snapshot of what the firm owns and owes at a given point in time. Now, assets are listed in order of decreasing liquidity. Now, what's liquidity? It's how easily an item can be converted to cash without losing significant value. So, current assets are definitely listed in that order. So I'm grabbing my book, and I'd like you also to do that and turn to page 21, which we'll see this picture next in our slide presentation. But you can see we categorize assets between current and fixed or long-term. Current assets are assets that will be used in the coming year. Fixed assets are assets that are not only be used in the coming year, but beyond in the business. And they're usually categorized between, for purposes of your books, tangible and intangible. So tangible are those that we could see and touch, property, equipment, buildings, land. Intangible are those that we can't touch, patents, copyrights, trademarks. We'll talk more about those. Then we have liabilities on the other side, which there's current and long-term. Current liabilities are those that will be due in the coming year. Long-term liabilities or debt are due beyond the coming year. And then shareholders' equity, where we keep track of the amounts the company owes to the owners. Now, if you see at your picture there, net working capital, that's the difference between current assets and current liabilities, or what's left after paying off current liabilities. So we remember the balance sheet identity as being assets equal liabilities plus equity. And there's our picture again. So total assets would appear on the left side, total liabilities on the right side, and equity. The difference between current assets and current liabilities are what we call net working capital. So that's the amount we have to work with after we pay off our current liabilities. So it's positive when the cash that will be received over the next 12 months exceeds the cash that will be paid out. So usually if we have positive net working capital, we are involved in a healthy company. Remember again, liquidity is the ability to convert cash quickly without a significant loss. Now, liquid firms are less likely to experience financial distress. But liquid assets typically earn a lower return. Here's an example. I knew somebody, a controller once, that she worked in a family-owned company, one owner, and the owner had significant amount of investments in real estate. And I remember she called me and said, "We're not going to be able to pay our payroll this week." I said, "What do you mean? Your owner is a millionaire." She said, "Yeah, but all of his assets are real estate. They're not liquid." And it was during a time that the real estate market was not doing very well. So if he tried to sell those, he could have sold them, but he would have taken a loss. He would have had to sell them for less than he paid for them. So when you are heavily invested in non-liquid assets, it's harder to meet your obligations. So financial distress could occur more easily with those kind of firms. However, if you invest everything in very liquid assets, in cash, if you just leave it as cash, it doesn't have as high of a return or earnings as maybe real estate would. So there's a trade-off, and you need to figure out the best balance. A firm needs to figure out the best balance between having liquid and illiquid assets. Here is a balance sheet for a company called U.S. Corporation. So you can see their specific current assets, and they're in liquidity order are cash, accounts receivable. Remember, that's where we keep track of how much a customer owes the company, and inventory. The fixed assets, this company only has plant and equipment, so maybe buildings and land and equipment. On the other side are current liabilities, accounts payable, and there's a current liability for notes payable. Usually they are considered long-term, like you could see down the bottom, long-term debt, but it depends on how long it takes or when the liability is due will determine what category it's in. Then we're in owner's equity. Now this is a corporation, so they have common stock and paid in surplus. What that means is, and what's kept track of in this area, is the total amount of money the company receives when they first sell a share of stock. So the first time a share of stock is sold into the market, it's the corporation that receives the money. So they're the ones who complete a journal entry in their accounting records, or an entry in their accounting records to say, we got cash, we gave the person stock. After that, they have no involvement in the transactions of buying and selling the stock. It's between other independent entities. So the first time a share of stock is sold, the corporation gets the money for it, so they keep track of how much they received in the common stock and paid in surplus area. Retained earnings is also another part of stockholders or owner's equity. That is the amount of the earnings or the profits of the business that are still in the company, retained, meaning they have not been paid out as a dividend. So net income of the company would increase retained earnings. Dividends decrease retained earnings because those would have been paid out. And if a company has a net loss, that decreases retained earnings. When you add liabilities and stockholders or owner's equity together, you can see they equal total assets. So bringing us back to our balance sheet. Now, a very important aspect of our balance sheet you need to remember is that it is not in terms of current value or market value. So the balance sheet provides us with what we call book value. And we follow what's called the cost principle in accounting in the United States. And that is, whatever you pay for something, you record it in the accounting records and you don't change it unless there's a rule that allows it. So a lot of the long-term assets, those fixed assets, are still either at their cost or maybe they've been decreased because of depreciation. So book value can be very different than market value. If you think of it, what is a building? Building you pay $100,000 for, you say you're going to use it 20 years. Well, over the next 20 years, the company actually expenses that $100,000 they paid for the building. But in the real world, that building may be worth more than $100,000 and be sold for more than $100,000. So they're very, very different. Market price, remember, is the price at which it can be actually bought or sold. Now, told you why they're different. Which do you think is more important for the decision maker? Well, it's the market value. It's the most current value that financial managers are looking at and using. And here's another example of a balance sheet, but now it's showing you in terms of market value and book value. So the company's accounting records state that there is $1,100 of assets, but in reality, if those assets were sold or cashed in at today's value, it would be $1,600. And that's what that's showing. The next financial statement is the income statement, and that is where we show revenues and expenses for a period of time. So we try to, according to GAAP, to the best of our ability, match expenses that were caused by a revenue in the same accounting period or on the same income statement. So we show revenue when it's earned, and then we match any expenses that that were required to generate that revenue against that revenue. That's called, again, the matching principle. So you're not looking at cash ins and outs on an income statement. You're looking at what you earned minus the expenses you needed to have to generate those earnings, that revenue. So here's an example of an income statement. So here we have net sales minus cost of goods sold, the cost of the inventory that you sold for those sales. And here they're just subtracting depreciation. There's other expenses, but we're keeping it simple here. That gives us what we call earnings before interest and taxes, EBIT. Earnings before subtracting interest expense or interest paid and the taxes you have to pay. Now we'll subtract the interest. That'll give us the part of income that is considered taxable. Well, now multiply it by the tax rate, which in the United States right now, corporate tax rate is a flat 21%. No matter what dollar of income you have, you tax it at 21%. So 131 are the taxes. When you subtract that from taxable income, that ultimately gives you net income. Now, there's two things you could do with net income. You could either put it into retained earnings or pay it out as a dividend. This company paid $123 as dividends, and the other $370 will be transferred to retained earnings. So we're aware publicly traded companies must file regular reports with the Securities and Exchange Commission. That's one of the reasons the Securities and Exchange Commission was created, to police the the public companies and also accounting. These are usually electronically filed and can be searched at the SEC public site called EDGAR. So you can click on the link within the PowerPoint to search for any company, any public companies, report filings with the SEC, because they are public information. And these companies also include them on their websites. So that is our income statement. One thing before we go to taxes, I want to bring to your attention, bottom of page 28, top of page 29, because we'll be getting into this more and we don't have it in our PowerPoint. There's something called product costs. Those are part of our, it could be in our inventory or our expenses. When you hear the word product costs, this takes you back to managerial or cost accounting, it's the same thing. It's raw materials to make a product. So when you're making the product, raw materials, the labor you needed to pay, direct labor to make that product, and then overhead items that are items that you have to pay for that you can't directly associate with making the product, the exact cost, but they needed to be paid in order to make the product. There's also what we call period costs. Oh, by the way, these product costs end up on the income statement as cost of goods sold. Period costs are incurred during a particular time period, and they usually affect selling and general and administrative expenses. Okay, so if you have any questions on that, let me know, but there's where our managerial and cost accounting comes into play, and we'll be revisiting those two terms, so we want to make sure you're familiar with them. Could you let him out? Sorry about that. The next area are taxes. Now we want to make sure we understand that there are corporate taxes in the United States. On page 30 of your book shows you what the corporate tax rate schedule was in 2017. It doesn't look like that now. Now, as I said, it's a flat tax. This is what we call a progressive tax. It means as your income increases, your tax rate increases. I wanted to run through the example with you on page 30, middle of the page. In this example, this company has a taxable income of $200,000 in 2017. How would they figure out their corporate taxes? Well, we followed the table, and what this table is telling us is the taxable income between 0 and 50,000 is taxed at 15%. The next 25,000 between 50,000 and 75,000 is taxed at 25%. The next 25,000 between 75,000 and 100,000 is taxed at 34%. And then the next taxable income between 100,000 and 335, well, their taxable income is 200,000. So it would be 100,001 to 200,000, or $100,000, is taxed at 39%. So each of those categories must be multiplied out that you did for each separate level and then added up. So the total tax for this company on the 200,000 is $61,250. So what is a marginal tax rate? Well, it's what the next dollar of income would be taxed at, what percent? Well, right now, the last dollar of income was taxed at 39%, and so would the next dollar of income. So we would say they have a marginal tax rate of 39%, or they're in the 39% tax bracket. Average tax is a calculation. Notice, you pay different percentages as income goes up. Okay, so what do you pay on average on 200,000? Well, you would take your total tax computation of $61,250 and divide it by the income you used to figure it out, 200,000. For this company, when they do that, their average tax rate is 30.625%. Okay. So, and this says check the IRS's website for up-to-date information, and I encourage you to go out and take a look. But it's currently at 21% or a flat tax. So now suppose your firm earns $4 million, and they don't give us the answer in the PowerPoint, okay? But I'm going to take you through the calculation, okay? If you take a look okay, 3 divided by 1. Okay. Oh, okay. I was looking at the table 2.4. But let's use table 2.3. It's 2017. Your company made $4 million. Well, again, the first 50,000 will be taxed at 15%. The next 25,000 will be taxed at, or I'm sorry, 25,000 will be taxed at 25%. The next 25,000 is taxed at 34%. The next 235,000 is taxed at 39%. Now the next range goes from 335 to 10 million. Well, we have 4 million. So let's take the difference between 4 million and $335,000. $3,665,000. Well, that much will be taxed at 34%. So now multiply them out. So you do that for each one. So the first one would be 15% of 50,000 or 7,500. 25% of 25,000 or 6,250. 34% of 25,000 or 8,500. 39% of 235,000, 91,650, and then 34% of 3,665,000, or 1,246,100. Add those numbers all up. So you take the 7,500 from your first computation, plus the 6,250 from your second, plus the 8,500, plus the 91,650, plus the 1,246,100, just like they do in the book. So your total tax on $4 million will be $1,360,000. So that's the firm's tax liability. What is the average tax rate? Well, now divide that computation of $1,360,000 by the $4 million total tax. Total taxable income. And it's 34%. So on average, you pay 34%. Every dollar overall, 34 cents goes for taxes. What would the next dollar of income be taxed at? The same amount, 34%, because right now, your next dollar, $4,001, would be taxed at 34%. And so would the next, for $6 million. So when it says if you're considering a project that will increase the firm's taxable income by $1 million, what tax rate should you use in your analysis? Well, the tax rate that would be used to compute tax on that $1 million, which would be the marginal tax rate of 34%. Okay, so it's the marginal tax rate we focus on when making financial decisions. So I run you through the old tax rate schedule because that's usually what is present, and it will be back. Right now there's a new administration in the executive office, and they changed it to a flat tax, but that's not normal. So that's taxes. So what's this concept of cash flow? How is it different? Well, cash flow is very important. It's one of the most important pieces of information when you're making a financial decision as a manager. And we get this information from the financial statements. The statement of cash flow does not provide us with the same information that we are looking at here, though. We will look at how cash is generated from using assets and how it is paid to those that finance the purchase of the assets. So a statement of cash flow that's included in the financial statements tells a decision maker how the company spends its money on operations, investing, and financing. We're taking a little different spin here. Let's take a look. We are going to determine cash flow from assets, and that always equals cash flow that we pay to the creditors, cash flow paid to the stockholders. So how do we compute cash flow from assets? Well, we determine operating cash flow first, which we'll show you how to do. Then we subtract any net capital spending, and then we subtract changes in net working capital. Now, how do we compute operating cash flow? So we're going to use the balance sheet and income statement for U.S. Corporation, and they were in a prior slide, and they're also on pages 23, and the income statement was on 26, 23 and 26. So, and the formula for this is in your book on page 33. how we determine operating cash flow is we take earnings before interest and taxes. We add depreciation and we subtract taxes. We don't subtract interest, okay, because that is part of the payment to the creditors. So we don't want to subtract it out because we're trying to figure out what's the total cash from assets that will be paid to the creditors and to the stockholders. So we take earnings before income tax off of our, and earnings before interest and tax off of our income statement, which is 624. I'm sorry, 694. 694. Don't subtract interest, but subtract taxes, 131. We add back depreciation. Now, we're trying to figure out cash flow. On our income statement, the one item that has nothing to do with cash, and when we're trying to figure out cash flow should be added back, it shouldn't have been subtracted, is depreciation. Depreciation is a pure non-cash item. So if we never subtracted depreciation, okay, our earnings before interest and taxes would have been higher, and the cash flow would have been higher. So we add it back. So in this case, when we subtract the 131 in taxes but add back the 65 in depreciation, our operating cash flow, that first part of cash flow from assets, is 628. The next item we want to determine is net capital spending. How much did we spend on investments this year? Okay. So how we determine that is we have to use our balance sheet and our income statement. So go to your balance sheet. We start with ending net fixed assets, which would be 1709. Then we subtract beginning. So that's how net assets changed. Ending minus beginning is how much they changed over the year. So that would be the 1644. Now, they also changed because of depreciation. So we need to, they decreased from depreciation, add it back. That's how much was spent in purchasing new assets. So that's the net cash flow from capital spending. So we spent 130. Change in working capital. That is, so working capital is the difference between current assets and current liabilities. So the first thing you have to do is go to your balance sheet and determine the net working capital as of 2018. 1464 is the current assets minus 389 current liabilities. $1,075. Now do the same thing with 2017. 1,112 in current assets minus 428 in current liabilities. Okay, so okay. 10. I'm doing this by hand. And let me get my calculator just to make sure I'm right. 1464 minus 389. 1,075, okay. And then 11112 minus 428. No, that's not right. 11112, okay, minus 428. 684. So the working capital at the beginning of the year is 684. The working capital at the end of the year is 1,075. Take the difference. So we take ending working capital minus beginning. So in this case, 1,075 minus 684, it gives us 391. So that's how much extra cash we had left over. That was either given to the creditors or the stockholders. So cash flow from assets will be operating cash flow, the positive 628, minus the amount of that you spent on buying fixed assets, minus the part that was paid to the creditors or stockholders, 107. That's how much, or you spent. That's how much is left over, 107. That is the cash flow from assets. Now, where did we spend that 107? Well, we either paid it to the creditors or the stockholders. So cash flow to creditors is found by figuring out how much money did we pay to them. The interest we paid is definitely paid to the creditors, but also we need to look to see, did we pay more off of the principal of our loans than we brought new loans in? So how do we do that? Well, we subtract beginning of the year minus end of the year long-term debt. So the beginning of the year is subtracted. 454 is the end of the year minus 408. So it increased over the year, didn't it? It went from 408 to 454. So more money was brought in, or 46. So we paid 70, but we got 46 from our creditors. So what's the net that we paid? 24. So of the 107, 24 went to the creditors. We do the same type of analysis with the stockholders, but now you've got to remember, what do we pay to the stockholders? Well, we pay them dividends. Now let's determine, did we get more money from the stockholders from the beginning of the year to the end of the year? We would look at the balance sheet and look at the area where we keep track of the money we record when we sell stock. That's common stock and paid in surplus. So you can see that balance went from 600 to 640. So that means the company received an additional $40 from the stockholders. So paid them 123, but got 40 from them. So what's the net amount that we gave them? $83. So the cash flow from assets, 24 of it was paid to creditors, 83 was paid to stockholders. So it's a different look at cash flow and how it's being spent. So this is another example that we could use to determine cash flow from assets. So let's take a look at it together. And I'm just going to stay on this slide, and you could grab a piece of paper and let's do the computations. So the very first thing we want to determine, you can see there's the current assets are there, so CA or current accounts. CA represents current assets, CL current liabilities. Then we have fixed assets and depreciation. NFA, net fixed assets. Long-term debt, LTD. Common stock and additional paid-in capital. That's your surplus. And then the income statement, earnings before interest and taxes. Then they give us the tax, they give us the interest, and they give us the dividend. So we have everything we need to determine cash flows from assets. So using your formulas in the book, again, we can go to page, I think it was 30, 23, blah, blah, blah. There we go, 33. Remember, to determine cash flows from assets, first we determine operating cash flow, which is found by taking your EBIT number, earnings before income tax, interest and tax, 1014, add depreciation because it has nothing to do with cash. It shouldn't have been subtracted to get to the earnings before interest and taxes, and subtract the tax amount, which is given as 193. So the cash flow from operating activities would be the 1014 plus 500 minus 193. or 1321. So that's one component, operating cash flow, and that's positive. Now let's look at capital spending. So our net capital spending is determined by taking our ending net fixed assets, which that one year is listed wrong, 2194, and subtract the 2017 number, not 2014, of 2261. So, oops, we'll subtract that. Now add back depreciation. And when we do that, we get 433. So we spent 433 as net capital spending. Even though it's positive, it will end up decreasing our operating cash flow. So from the operating cash flow, we spent 433 in capital spending. The next is net working capital, which is the difference between current assets and current liabilities as of the end of the year. So the end of the year, our current assets are 3625 and our current liabilities 1787. So 1838. Our net working capital at the beginning of the year is the 3596 minus the 2140, or 1456. So 1838 minus 1456, 382. Okay, so we're going to subtract the end of year from the beginning of the year, and that change or increase is actually subtracted from our operating cash flow. So we'll take our 1321 in operating cash flow minus the 433 in net capital spending minus 382 in change in net working capital, and that will give us cash flow from assets of 506. Now let's see how much of that 506 goes to creditors and how much of it went to shareholders. To determine the amount that goes to creditors, we start with the $93. That was definitely paid to them. But now we have to see what impact does additional borrowing have, or was there additional borrowing, or did we pay even more than the interest off? And how we determine that is we take the difference between the beginning of the year and the end of the year. So the end of the year, the balance in long-term debt is 538. The beginning of the year, it's 581. So it actually decreased. So we paid even more than $93 in interest. We paid an additional $43 of principal off. So add the 93 and the 43 together. Of the amount 506, $136 of it goes to the creditors. That's the cash flows to the creditors. We'll do the same computation for the shareholders. Remember, the first thing we say is what was definitely paid to the shareholders. Well, 460 in dividends. Now let's see, did the shareholders give money? Okay, or did we give even more money to the shareholders? Well, we determine that by taking a look at common stock and additional paid in capital and take the difference between the two balances. The beginning of the year balance was 372, the end of the year 462. So it looks like the difference of 90 increased. Increased the amount of common stock. So that means we might have paid $460 out, but we received $90 in from those shareholders, those new shareholders. So we're going to take the difference between 460 and the 90 increase. And that's how much of that cash flow from assets went to the stockholders. So if you take the 370 plus the 136, that accounts for the total 506 cash flow from assets. Okay, so that was a great example to go through. And if I, come back and listen to it again, and if you have any questions, please let me know. Oops, and there it is, completed. So there is all of those computations we just did. I forgot it was there. Okay, so this is just a little quiz at the end. We're not going to take it. What is important to remember is that we must stay ethical. So why is there manipulation of financial statements? And why is it not only unethical and illegal, but also bad for stockholders? Well, when people on financial statements are fraudulent, they're manipulated to make the company look better, let's say. People make financial decisions based on that, and they trust in those. So if they're wrong and the company isn't doing as well, it will come to light. And a stockholder can lose a lot of value in an investment. Their personal money is invested in this company, and they invest in it trusting that they're doing the ethical thing and preparing financial statements correctly and not manipulating numbers. So it can impact the stock price and then hurt the return to the stockholder, and it could hurt the market overall. That's why we have the SEC and have Sarbanes-Oxley, to protect the financial market. Here's another comprehensive problem that you can compute, and if your cash flow from assets equals your cash flow to creditors and stockholders' equity, then you completed it correctly. Okay, so that's the end of our discussion on Chapter 2. Please be sure you post any kind of questions on the discussion board and go back, especially if you're a little rusty on your accounting, and take a look at it.